Today we have an uncommon two-letter ticker Tennessee company. It's a dollar store. Most of us have been to a dollar store, maybe. I literally was just at one about an hour ago. Let's do the classic opening move and go straight to the item 8. Auditor is calling out estimates used for workers' compensation. Maybe we look into it, maybe we don't have to. I want to remind everyone that at the end of the video, I'm going to be putting this into a valuation ranking. It does use AI. This company is part of the 2023 season, and so it will actually be the fourth company. It's kind of early on in the 2023 season. Most companies haven't put those annual reports out yet. That being said, though, pretty good odds that you might be able to guess the ranking. So try to guess where Dollar General is going to rank 1 out of 4. If you want to skip ahead, timestamps are in the description, and all my videos are designed to be navigated as you please. Let's dive in so that your wisdom can blossom. More inventory in this year compared to last year. Overall, we see retailers maintain a more balanced makeup between assets and liabilities. In this case, total assets is 29 and total liabilities would be this number minus the shareholder equity number. It would be roughly 23 and a half. Pretty solid, I would say, for a retail store. Retained earnings in the billion and a half mark, almost was 2 billion a year ago. Now this did dip by about a third in just the last year. Maybe that's an interesting angle here. Moving on to the statement of income, doesn't really reveal why retained earnings changed. 3 billion extra in cost of goods sold, the difference between these numbers. Now, there was about roughly a 3 billion extra in net sales. And so you actually saw net gross profit continue to increase. Other than the interest expense, which doesn't seem crazy by any means, it looks completely fine. Everything is a little bit mysterious, actually. Like it's a growing retailer, nothing crazy, just regular growth. Let's peer into the statement of cash flows as well to complete the opening move. Well, we can say that in their working capital, they actually did make one big change, which is that they more than doubled, actually almost kind of tripled their investment into merchandise inventories. That would show up in the cost of goods sold. Even though gross profit didn't seem particularly affected, maybe the real way to think about this is that the net margin was impacted because the SG&A was not receiving benefit from this part of cost of goods sold. And so the workers were not selling this investment. This is an increase in the baseline level of merchandise inventories. Sometimes you see retailers do things like this because of inflationary environments, actually. The logic being that if you can stock up your inventory today before inflation hits, then you can be more flexible. Dollar General being able to have long shelf life inventory in the stores would definitely be aware that this is an option for them, and at even a chance that inflation was going to become a problem, they could see it as accretive to shareholders to mess around with the timing of their inventory stocking, especially if they have the storage space. CapEx actually did increase by 50%. Their purchases of property and equipment is 50% higher than in the previous years. This could actually be a case of they didn't have the storage, but they still thought it was worthwhile to protect themselves from possible inflationary pressures by purchasing more storage and then filling it up this year rather than wait for potential inflation to hit. That actually does explain a lot more of why we saw net income tick down despite the increase in revenue and increase in gross profit. It's very likely that that's the explanation here. Let's follow up on this with some notes. Dollar General is making a move here. What is their rationale for making this move? They do have a note on merchandise inventories, and they do use last in, first out, which please check out my video on @core, the very first video I posted, if you want more in-depth explanation of how your inventory accounting method has an implication. But the short version is that Dollar General is implying that they don't mind holding inventory for more than a year when they use last in, first out. Their inventory cost did more than double compared to a year prior. They've been actually including a provision, but for the purposes of what the rest of the financial statements were telling us, we can simplify this provision to be money saved on behalf of Dollar General in case they have to restock at inflated prices due to economic inflation. And what we can see is that their kind of nest egg, their piggy bank for specifically rising inventory costs was about $500 million in 2022. That is 100 times more than in 2020. I'm not exaggerating when I say 100 times more. It's 517 million in 2022. It was only 5 million in 2020. Arguably, maybe they didn't have this at all before the pandemic. This provision, very interestingly, is included in cost of goods sold. And so not something I've seen too often. I'm curious if other retailers are doing this to their cost of goods sold as well. In the short term, it does kind of front load some of the cost, and so giving yourself some less flexibility. In fact, the video just earlier this week for Texas Instrument was talking about how gross margin can allow a lot of capital allocation flexibility. Well, if your gross margin is being lessened, as this very much is a willful decision on their part to do, you're actually allowing less flexibility for capital allocation. And so it's not good or bad. It is a conscious decision, though. Hey, if you're getting more comfortable uncovering the stories behind the numbers, please like and subscribe. Let's see if their property and equipment note will confirm to us whether it was additional storage that they're buying. That would be fascinating to confirm. It is some leasehold improvements, which we might have to look into what that actually is. And but also about 800 million of it was furniture, fixtures, and equipment. So a wrinkle into what I was thinking. 200 million was construction in progress. This would be the closest thing to additional storage space. That would be where I'm imagining they would include it. Real sleeper story here is the furniture, fixtures, and equipment. Now, furnitures could be shelves to fill up with storage. 800 million of shelves. Is that actually what it's like? I'm hoping maybe they give a little bit more detail, but they don't, which is fair enough. I wouldn't actually not expect them to spend the time. I mean, there's a lot that goes into an annual report. I find it completely fair that they're not telling us the details of furniture, fixtures, and equipment. I might just not know how much shelves are going for these days, but 800 million is being spent on furniture. Some degree of that, I think, is very likely to be shelves. It could also be just maybe revamping the actual furnitures in the store. Dollar General is deciding, let's just refurnish stores to a certain degree before prices hit up. Either way, what you see with CapEx, sometimes it's constantly growing to new levels, and you in the future will have to continue to maintain that level. But things like furniture, fixtures, and equipment, you will not have to buy that again. Things like buildings, you will not have to buy that again. It's very likely that this will not stay at the new level. As a quick reminder, CapEx would be the rate of growth of these things that we're looking at right here. And so capital expenditure would be the rate of growth of property and equipment, but I've been using them interchangeably just because we only have 1 year difference here. So I've transitioned to the item one, and I actually skipped the entire business description, which is almost always where I look at the item one. I wanted to, with you guys, kind of put out a theory and then let's see together if it's going to actually play out. This risk factors I often don't look at, but it is the company being encouraged to identify the risks that they're most focused on and that they're handling. Maybe not always necessarily handling, but at least aware that they exist. And investors love it when companies talk about risks. I haven't looked at the risk factors yet, but if the first, second, maybe even the third, let's say if the one of the first three, I'll give myself that extra chance, risks is talking about inflation, then I think this story that we got from the opening move is the correct story. I'm already pretty sure that elements of it are very much what's happening, but I haven't actually seen something that makes me feel as confident as I normally am that the story I'm telling you guys is a real story, right? I'm not going to be perfect, but generally, as a financial analyst, we should be able to figure out. Dollar General here has been making a very good annual report. I think we can figure it out, and I think we're going to figure it out if we can confirm that they're worried about inflation as a major risk. And so let's scroll down together. Economic factors, okay, customer spend. Oh, but no, this is inflation. This is inflation. This is the very first thing. Fantastic. Well, let's look at it together. They're talking about customer spending, but they're talking about increases in costs and expenses. Here we can see higher fuel, energy, healthcare, and housing costs mean that it is both harder to sell things to customers because everyone is dealing with inflation, and that's particularly going to impact the people going to Dollar General, unfortunately. But it's also going to mean higher cost in terms of you have to market more. You have to have more staff, have more hours in order to maintain sales when your customers are going to be less willing to spend money. It's going to continue tax rates, lack of available credit, tax law changes. They're being very broad here. And I actually am a little surprised at how broad this risk that they're perceiving is. They really, really have a strong understanding of the type of customers that are their bread and butter business, which I love. It's even talking about decreases in or elimination in government assistance programs, subsidies such as unemployment, food nutrition assistance programs, and economic stimulus payments. The brightest view of this, when economic stimulus was fairly commonplace during the beginning of the pandemic in 2020, Dollar General did see a benefit. Many retailers saw a benefit, but especially companies like Dollar General saw benefits from people now having disposable income, which, if we're being honest, not everyone has necessarily the fortune of knowing what it's like to have disposable income very often, at least. Everyone usually has disposable income for portions of their life, but the average person will go through months where they don't have disposable income, and that is the reality for almost everyone. Dollar General is very much aware that they want to be here when you when you go through one of those things, or if you go through one of those things. And then final nail in the speculation coffin, they even now are saying, if it hasn't been clear yet, inflation in the United States rose significantly in 2022. We believe the growth rate of inflation is beginning to moderate. If inflation continues to increase, we may not be able to adjust prices sufficiently. We may experience material adverse effects. Everyone, of course, it's very common to experience adverse effects in a recessionary environment, but not everyone is going to put that as the number one risk factor in their annual report. Dollar General wants investors to understand that they specifically will be more like particularly impacted adversely in these sorts of situations. They know what they are. They know the value they provide in people's lives. I do want to talk up Dollar General. Retailers all have this common thread of finding their target audience and then really, really understanding the customers that they want in their stores. Dollar General has a particularly broad target audience because, again, virtually everyone will have times in their life when disposable income is low. That target audience of people with low disposable income is a very broad audience, and yet Dollar General masterfully shows what a retailer should be focused on. They're not shying away from, oh, there's so many people in this category, it'll be hard to understand them well. This annual report oozes understanding of who their clients are and who they want their clients to continue to be. Very, very good case study, I would even say. I would even go as far as to say that people who want to work in retail should look at Dollar General as an example, a shining example even of what it means to be a store that you want people to trust and to remember and to go to when they need stuff. Dollar General is going to be the fourth company we're adding to this valuation ranking in the 2023 season. Remember that the only other video I've posted here is in video, which took the number one spot just about a week ago. Please like, subscribe. Tell me when's the last time you went to a dollar store. Was it Dollar General or was it one of its competitors? Share your wisdom and share this video. Dollar General is ranked 1 out of 4 in value for the 2023 season. Surprisingly, I'm sorry to be so blunt, it knocked down Nvidia and like barely knocked it down. But I don't want to give away too much, but I can say that it basically has to do with the fact that Dollar General actually is only a little bit less profitable than Nvidia. So the rest of it just comes down to the price at which these companies are selling as of when I'm making this video. None of this is investment advice, but it does take into account price. It is a valuation ranking. Put respect on these retailers' names, I swear.